Welcome everyone to the webinar. Thank you for coming. This is the fifth webinar of the Traders Bookshelf series, and we are very excited to present you with another addition to our book list. Today we'll be discovering a recently published titled Currency Trading in the Forex and Futures Markets by Carly Gardner. She is a senior market analyst and broker with the Carly Trading and a columnist for Stocks and Commodities magazine, also the author of Commodity Options, published by FT Press, and presenter of the video course, Live Sessions, a crash course in commodities. Her newsletters, the Carly Perspective and the Financial Futures Report, have garnered a loyal following. She is also proactive in providing free trading education. The book we are talking about today is a concise, easily digested snapshot of the currency market. At fxtrade.com, we found this book to be a solid introduction to trading the FX market through a variety of instruments. Carly explains the differences between FX ETFs, futures, options, and so on, and also a good fit for more experienced investors already well-versed in stocks or futures and looking for a new market to trade. These two groups of readers will benefit a lot from the book's comprehensive explanation of the mechanics in this market. What is a market maker? What is an ECN? Their advantages, disadvantages, just to name one of the aspects covered. Carly provides simple and well-organized ways to scan the FX markets for buying and selling opportunities, and more importantly, how to survive overcrowded trades, a concept we may ask her more about. With the use of simple tools like historical highs and lows and price deviation from those extremes, as well as how to profit from herd behavior with the use of contrarian tools like the Commitment of Traders report for sentiment and positions in the market. Carly is one of those analysts and traders who knows that information is useful, but it isn't the holy grail. After all, we all have access to pretty much the same information. It's the way markets discount that information that results in an ever-changing price behavior. The other day, in an educational webinar, we talked about the discounting mechanism as one of the basic tenets of those theory. In this book, however, Carly goes beyond the theory and finds practical ways to discern how information is being digested by the majority of market players. I personally enjoy the rich vocabulary used in the book. Only a person with a vast experience can write a book about financial markets that results in a pleasant educational journey. I'll give the microphone to Carly now. Perhaps we can start by asking her some of the questions she addresses in the book, one of them being why it is so difficult to win in the Forex markets. Thank you.
Well, I certainly appreciate the introduction, and I'm excited to be here. I'm very grateful for FX Trade for putting these types of presentations on. I think it's great for traders. We all know that the markets are tough, and the more educated you can be, the better odds you have of success. But as we've already kind of discussed slightly, everybody's dealing with the same market information and the same tools and the same indicators. So a lot of it, as far as making or losing money in the markets, I believe is a mental game. I think it's 90% mental and only 10% strategy and homework and those types of things. I'm going to go ahead and I've got a little slideshow set up for you guys. Now this is, hopefully you can see this. This is a little bit different than, I actually sat in on a couple of the webinars that were prior to me. This is a little bit different, and then we're not going to attempt to tell you when to buy, when to sell, or give you, some magic strategy. But what I'm just going to go over real briefly is talking about the three different venues to trade currencies in, and why one might be better than the other, or for you, or maybe one might be better than the other for somebody else. And we're just going to kind of go over that and see where the most efficient place to trade currencies might be. The title of the presentation is actually the title of the book that we're just discussing, Trading Currencies in the Forex and Futures Markets. And we also actually touch upon ETFs as well. Very briefly, if you have any questions or comments or concerns throughout the, after the presentation, you think of something that you forgot to ask, here's all my contact information. I'd be able to, love to be able to help you out. There's also a lot of free trader education on our website, thecarlytrading.com. We are a brokerage firm. A lot of people don't really understand what it is that we do, but for full disclosure, we are a brokerage firm. That's how we make our living. But we do a lot of these educational classes for a couple of reasons. One, to try to help people before they get into the markets and before they put their hard-earned money on the line. But of course, we're also trying to get our name out as well. A lot of this has already kind of been discussed, so I'll go through it real quick, but I am a broker, a strategist, and an author. I've actually written 3 books, so if you like what you see today, we're going to be talking about currency trading in the futures and Forex markets, but if you have interest in commodities, that's kind of where our bread and butter is. Most of our clients are trading futures and options on futures. We've written 2 other books that might be of interest to you. Before we go any further, I just want to clarify to everybody that there is a substantial risk of loss in trading futures, options, and Forex. I should have put that in there. So futures, options, and Forex, very risky. Obviously, with risk comes reward, but I'm sure you've all heard that 80% of the traders lose and 20% of the traders make the money that the other 80% lost, and I would say that's probably true, and maybe even a little worse than that as far as how many people are losers. But you can imagine those people that were able to somehow or another control their emotions enough to manage their risk and to do all the right things, it can be quite lucrative. I don't expect you to read all of this, but I just want you to understand again, this is risky business. Past performance is not indicative of future results, and we do the best to provide you with the most current and most accurate information, but we can't guarantee, nothing is ever guaranteed. Okay, currency trading venues is where we're going to start. There are 3 primary means of currency speculation. There's the Forex market, which I'm quite confident that each and every one of you are aware of and maybe even trading in. There are currency futures, which my guess is many of you know about, but you've perhaps overlooked them. And there's also ETFs, which are exchange-traded funds, which you could trade through a stock account. We'll talk about the pluses and minuses of each really quickly as we go forward, but my personal opinion is that probably most traders are better off trading currency futures in some cases, and that everybody's different and every situation's different. Sometimes Forex is better. You have to look at margining, you have to look at all types of different things, and that's what we're going to talk about. Okay, we're going to start with Forex. Forex is, without a doubt, the most popular currency venue. Why? It's hard to say. I mean, I think the Forex industry was built on fabulous marketing, great technology, and, traders like that. And traders know about it, so that's where traders tend to go. But that doesn't necessarily mean it's the best for everybody. With that said, though, Forex is, as you probably know, a worldwide, decentralized, over-the-counter financial market in which speculators and banks can facilitate the trading of currencies. Now, the crazy thing about Forex, well, it's not crazy to you because you all know what Forex is and you've probably been trading it, but for people that trade futures or stocks, they don't realize that Forex is actually, it's not one market. It's not, it's not traded on exchange. It's traded on multiple markets. It's kind of a conglomerate of markets. It's almost like if you think about the stock market, you're usually thinking about the New York Stock Exchange or the NASDAQ or whichever it is. But when you think about Forex, you don't think about each individual market. You think about it as a whole, but it actually is individual markets. The term Forex covers all Forex markets, traded all over the world in several mini markets, if that makes sense. There's no exchange, which means there's no exchange guarantee, and there is counterparty risk. As a Forex trader, you're kind of taking your life into your own hands. You can make all the money in the world that you want in your trading account, but if the person on the other side of your trades isn't able to pay up, it's not going to do you any good. Now, the chances of this happening are probably rather slim, but it does happen. You remember REFCO. You probably have heard of PFG, which was a commodity brokerage firm that also offered Forex. And just to give you some insight, we don't know how that's going to pan out with Forex traders, but it seems like a lot of the Forex traders will get far less money back than the futures traders did, and maybe even nothing. So there's definitely a little extra risk in trading Forex as opposed to futures. Now, let me just real briefly mention that I'm located in Las Vegas, Nevada in the United States. And so a lot of the regulations that I'm going to refer to are for U.S. regulations. And I know it's a lot different overseas, and I'm sure a lot of you are trading in different countries and have different rules and things like that. But unfortunately, it's impossible to kind of cater to everybody. So this is all based on somebody trading, living in the U.S. and following U.S. rules. We all know that Forex is basically an electronic contract to make or take delivery in about 2 days. Forex is also known as a spot market because delivery is immediate. It's delivered on the spot. There's 3 types of Forex brokers, and this is where even people trading Forex sometimes don't always realize or even understand. There's an ECN, which is an electronic communication network, and this is basically an ECN broker is somebody that provides clients with access to a viable market with liquidity providers. The liquidity providers might be banks, might be institutions, might be professional traders, it might be all of the above. But the point is, the brokerage firm is not creating a market for you. They're not making a market for you. They're just bringing you to a market that already exists and is extremely liquid and vibrant. An ECN broker charges a markup commission. So you hear in Forex, commission-free trading, that sort of thing. Well, if you're trading with an ECN broker, you will pay commission. You're going to pay a markup. But you're also paying a very, very, very tight pip spread. In fact, it might be less than a pip. So even though the commission is more transparent, you see it on your statements, you have to live with it, it's actually probably cheaper than trading with what's called a non-ECN broker or a dealing desk. With a dealing desk, the brokerage itself makes a market for its clients by acting as liquidity providers. So in other words, instead of trading against banks and institutions, clients are actually trading against their own brokerage firm. If you pull up a quote, if you're trading with a non-ECN broker and you pull up your quote board, you're going to see bids and asks. Well, those bids and asks represent the price that the broker is willing to execute your trade for. If you pull up a platform through an ECN broker, you're looking at quotes that other traders or other market makers are willing to execute for. With a non-dealing desk, there's no commission. However, the firm isn't working for free, obviously. How the firm makes money is they're charging a wider pip spread than what would be found in a normal ECN market. In fact, a lot of the dealing desk brokers or the non-ECN brokers, they will actually execute your trade for you. If you're buying, they'll sell it to you, and then they'll go into an ECN market and take the other side. So they don't really have any price risk, but they're benefiting on the pip spread that you're paying. You might also find hybrids. There are some firms that are actually both an ECN and a non-ECN in different situations. A lot of times the bigger transactions or the bigger accounts will go to the ECN side of things, and the smaller transactions like the minis or the micros are sent to a non-ECN. And this is actually not such a bad setup, because if you're trading minis or micros, it's probably not going to be the end of the world to be trading with a non-ECN broker. In fact, maybe it's even a little more convenient for you. But if you're trading larger size, I would say the cost efficiency and the fact that you're just trading a transparent market is probably beneficial in the ETN market. I noticed a question real quick from one of the attendees asking, is futures not risky? Well, of course, futures is risky, so is Forex. It's all risky. It's all leveraged speculation, and we don't know where the market's going and when it's going. But futures is less risky in a way just because there are rules and regulations in place to protect client funds. When you open an account and you wire money to your brokerage firm in a futures account, by law, that futures broker is supposed to keep your funds separate from their funds. In other words, they keep it in what's called a segregated account, and they don't pay their bills with it, and they don't use it for operations. In theory, your client money should be in that account. Even if the brokerage firm goes under, your money should be safely in the account. We've learned tragically in the last year that brokers don't always follow the rules, and so even though those rules are in place and have worked for the last several decades, or maybe even a century, for some reason last year with MF Global and PFG, those two brokerage firms for the first time in history decided to break the rules of segregated funds and actually used client money for firm purposes. But that's something that has never happened in futures before, and hopefully will never happen again. On Forex side of things, it's not necessarily more common that a brokerage firm goes down in Forex, but if a brokerage firm goes bankrupt in Forex, there's absolutely no rules whatsoever that says that brokerage firm couldn't have used the money that you sent to them to fund your account for their bills or for their operations. There's no segregation of funds in Forex. That's why it's a little safer to have your money in a futures account as opposed to a Forex account. And again, I mentioned PFG. PFG had both futures and Forex, and I'll tell you right now, the futures clients are being treated preferentially to the Forex clients. I'm not sure if the Forex clients will end up getting anything back, but we just don't know. It's too early to talk about that. Here's the nuts and bolts of Forex. There are definitely advantages. It's 24 hours. They offer high leverage, low margin. If you happen to be on the right side of the rollover, you actually receive interest for that, and that's what triggers things like the carry trade, where traders get into interest-bearing positions and sometimes become complacent, so you have to be careful with that. But it's definitely an advantage to have interest paid to you when you have a trade on. If you're trading with an ECN broker, you're probably trading in an extremely liquid market. If you're trading with a non-ECN broker, you're really only trading against one person, and that's your brokerage firm. That doesn't mean that they're not going to be on the up and up. I mean, they might give you great fill execution, and they might be really, really, operate with an integrity, but there's just no guarantee. Some people like the idea that there's more funding options in Forex than there is in futures. I mean, you can fund with credit cards, you can fund with just about any way you can get money to a Forex broker, they'll take it. And that's because there's really not a lot of regulation. In the last couple of years, regulators have stepped in and kind of taken hold, but there's still a lot less regulation in Forex than there was in futures. Now, with that said, I think funding with a credit card, in my opinion, is a horrible idea. I mean, it's basically leverage on leverage, because with a credit card, you're not putting up real money, you're putting up credit. So you're putting up credit to margin your trading account, which is also, margin is basically you're trading on credit, right? So it's like credit on top of credit. And even if you're the type of person that pays off your credit card bill each and every month and doesn't pay interest on the credit card side of things, it's only going to take one really bad decision, one bad month, for you to push the limits a little bit, maybe go over your spending limit, and end up losing money in your Forex account that you don't have cash for to cover on your credit card. And you end up basically paying it. Not only did you lose money and you went through the agony of all that, but now you're going to pay interest on it. In some ways, Forex is a little easier to to deal with because it's standardized worldwide. No matter where you go, it's always going to be the euro dollar, and it's always going to be quoted the same with the same number of digits and the same symbol. In futures, it's not quite that simple. There are standardized symbols, but each trading platform might use slightly different variations, so it's a little bit little crazier as far as a newbie coming in trading. But as we mentioned in Forex, the big disadvantage is counterparty risk. There's a lot of complex math. Sometimes if you're not on the right side of the rollover, you're paying interest, and that's just super annoying. Liquidity might be a problem if you're with a non-ECN broker. And we mentioned the lack of regulation. Hidden transaction costs if you're not with an ECN broker. All Forex brokers tell you don't pay commission. It's commission-free trading, but I'm telling you, it's actually very expensive trading. If you add up the pip spread that you're paying, it can be quite substantial. In fact, a lot of times it's more than what you would pay if you were just paying commission on futures or paying a markup on with an ECN broker. So you just have to be careful with that. Okay, we're going to talk about currency futures now. Unlike Forex, currency futures are highly regulated, and they have been for a very, very long time. And again, I'm talking about currency futures traded in the U.S. Outside of our borders, unfortunately, I'm not quite as knowledgeable on those types of things, but hopefully you are. Anyway, if you're trading on U.S. exchanges, you're trading currencies on the CME division of the CME group, which guarantees every transaction. Unlike Forex traders that face counterparty risks, again, I said if they make a good trade and they make money in Forex, that's great. But first, they have to make sure that the person on the other side of the trade pays up, and that doesn't always happen. It usually does, but it's not guaranteed. Well, on the CME, if you're trading futures, it's guaranteed no matter what. The CME guarantees the transaction. With currency futures, the broker never becomes part of the transaction. All a futures broker does, which is what I do for my clients, all I do is provide them access to the market. We give them a platform, we set up the networks, we get everything ready for them so that all they do is click a button and they execute on the exchange. We never touch the transaction unless they're a full service client and I'm placing trades for them, but that's a different story. Currency futures are transparent. You can see the transaction cost. It's a commission and it's on your statement, and that's what people don't like. With traditional Forex and a non-ECN broker, people like the idea of they pull up their statement and they don't see any transaction costs, so they feel like it's a free service, but it's not. Just because you can't see it doesn't mean that you're not being charged. In currency futures, it's very transparent. You know exactly what you're paying and what you're not paying, and also the market is transparent. You can see volume data. You can see price data. In Forex, like I said, it's multiple markets. It's, who knows, hundreds of markets maybe even more throughout the world. And so there's really no way to calculate data or things like that. It's really quite a bit less transparent. Let's put it that way. Somebody is asking that, am I a CTA? No, I'm not a CTA. I'm a broker. I'm not registered as a commodity trading advisor. Most of our clients are basically trading discount online or full service, but I do not. I do manage a few accounts for particular clients, but that's not the business that we're in. Yes, there are mini lots in futures, and there are actually even e-micros, which I'm kind of a big fan of. The mini lots are half the size of a full-size contract. So in the futures, we'll just take the euro because that's the most popular currency. The euro it's basically the euro-dollar pair is what it is, but it's a futures contract. So if you're trading the euro, you make or lose $12.50 per tick, which is equivalent to a pip in Forex. So it's $12.50, and unlike Forex, it doesn't change. It's always going to be $12.50 no matter what the heck happens. It's $12.50. That's it. A mini contract is half that. So a mini contract is 6.25. And then there's also e-micros, which are 1/10 of the size of the original. So it's $1.25. Now, Granted, the minis and the micros are not, in the futures side of things, are not as liquid as I'd like to see them, but they're newer products, and I think the liquidity will come. However, even though they're not super liquid, there are great market makers. Almost 24 hours a day, you can see very super reasonable bid-ask spreads. And so, even though you can see that the market's not super liquid on the minis and the micros, in all reality, if you're trading with an ECN broker, you're facing even less liquidity because you're trading against your broker. At least in the futures market, even though you can see, okay, there's only 10 contracts working on the bid and a few on the S. You know what? At least you know exactly what's there, and it's not just one. It's not your broker, and you can see what's happening. So it's not a perfect arrangement, but especially if you're trading the E micro currency futures, which is $1.25 a tick, if the spread's a little wider than maybe what it should be, that extra buck probably isn't going to make or break your trade. You're either right or you're wrong, and that's that. Okay, in a nutshell, there are definitely advantages to and disadvantages to futures, but on the advantage side, there's nearly 24-hour access, but unlike Forex, which trades around the clock with no resetting or constantly moving, the CME Globex does close for about an hour each afternoon. Now it's a time where nobody's really trading anyway and the volumes are light, so it's probably not a big deal 99.9% of the time, but sometimes it can be a little annoying to know that you have to wait a few minutes to put your order in, things like that. But obviously the advantage, like we mentioned, is there's no counterparty risk. The CME guarantees all transactions. There's no dealing desk. There's more transparency. The math is very simple because everything is paired against the dollar, or at least it's simple for us in the United States because we know that the dollar is always going to be the quote currency in the futures market. And this is different than in Forex, where sometimes the dollar is a quote currency, sometimes it's the base currency, but in futures, it's always going to be the quote currency. And so it makes things much easier, which is why we can say, the euro is always going to be worth $12.50, or the Canadian dollar is always going to be worth $10. So in futures, there's really no questions on math. It is what it is. We talked about segregation of customer funds from brokerage firm funds in futures, and that's, again, brokerage firms, Forex or futures, they don't go bankrupt every day, and it might only happen once every 10 years. But I'll tell you what, if you're one of the people that has an account with a brokerage firm that goes under, it's once in 10 years is more than enough, trust me. And you're going to be much better off if you have money in a futures account as opposed to a Forex account. One advantage of futures also is there are actually experienced full-service brokers out there. In Forex, there's really not a lot of that. I mean, I know most people like to place their orders online, and that's fabulous. But there are still some people out there that would rather talk to somebody and bounce ideas off somebody, and that's fine too. But if you're trading Forex, you're probably going to have a harder time finding a broker that's capable of doing that for you, capable or willing to do that for you. One of the big disadvantages of futures as opposed to Forex, and Forex was built during the heyday of technology. Forex has always had, very nice trading platforms, very high-tech trading platforms. That's kind of what the industry was built upon, and that's how it competed with the futures market and the stock market. And because it's not a centralized exchange, because there's many different markets, and the data's a lot easier to come by. In the futures markets, the data is owned by the exchanges, and the exchanges don't necessarily give it out for free. So there are some challenges to access market data and live charts and futures that you wouldn't get in Forex. And this does, in some cases, depending on your brokerage firm, but it may or may not add to the cost of your trade. Okay, really briefly, I know I'm kind of running out of time here, but I just want to touch on currency ETFs, exchange-traded funds. Obviously, a currency ETF tracks either a single foreign currency or a basket of currencies via foreign cash deposits or futures contracts. Probably the most popular one is the FXE, which is the euro. And, but there's a lot of others out there. There's the UP, UUP, which is the dollar index. And all of these things are great in theory, but they're not perfect. I mean, usually people flock to the ETFs just because it's simple. I mean, everybody has a stock account. Not everybody has a futures or a Forex account. So anyone with a stock account that wants to trade the euro might decide, well, I'm just going to go into the ETF because it's right there. I don't have to open another account. I don't have to sign any other agreements. I'm good to go. But it's probably the least, in fact, I'm not going to say probably, it is definitely the least efficient means of speculating in the currency market. I mean, my question to people that trade currency ETFs is really, why trade an instrument built to mimic the underlying when you can just trade the original in the first place? And I understand that not everybody is interested in high leverage, high margin, risky trading, but you know what? You can do micro Forex, or you can do microcurrency futures. I mean, you can do it on a really small scale to where your risk is manageable without going into the ETF market. ETFs are built to follow an asset in the short term, but in the long run, positions really don't always conform to expectations. Just because you're bullish the euro and you buy the FXE, the euro even goes up, doesn't necessarily mean you're going to make money on the ETF, because there's a lot of inefficiencies. There's high expense ratios, there's high internal trading costs, and you have to pay a commission on top of that to get in. So your fee-wise, it's actually very, very expensive, even though the expense ratio and the internal trading costs you don't necessarily see. Those are all built into your profit and loss. There's very limited market access. I mean, you're dealing with stock exchange hours, and stock traders just aren't as frisky as futures and Forex traders. They like to sleep, I guess. A lot of the ETFs that are listed are extremely illiquid. ETFs, at least in the U.S., come with generally higher tax rates, complicated tax reporting. But on the bright side, they're convenient. They're convenient to fund the account. It's convenient to access them, and that's really why a lot of traders go to the ETF markets. But as you can imagine, I'm not a huge fan. Here's just a really quick rundown of, which market may be optimal for your circumstances, and you can just kind of take a look and see where your priorities are and which one might be the best fit. In my opinion, the best overall, well-rounded venue for trading currencies is the futures markets. I mean, by the way, I'm a broker. I'm a futures broker and a Forex broker, so it's not like I'm telling you to trade futures because I'm a futures broker and that's the only way that I make my money. I also am a Forex broker. But and there's definitely some times for Forex. There's times where the Forex margin is a heck of a lot cheaper than futures, because Forex margin changes throughout the day. It changes with asset values. Futures is not dynamic. It's static. The exchange sets it, and they usually only adjust it maybe once or twice a year, if that. So there are times where Forex margin is at a high discount to futures, and sometimes it makes sense to trade Forex. So I'm saying, it's a good idea to have access to both, and for your situation, maybe Forex is better. But I would say generally, futures offers a more efficient, cheaper, and more safer, quote unquote, place to put your money than possibly Forex. Appreciate everybody coming out. Please, if you have any questions at all, feel free to contact me by email. Visit our website, decarlytrading.com. If you're looking for more education, we've got some free videos, some free articles. All right, it looks like I missed a couple of questions here. Let me just run through them real quick. Can you lose more money in your account in futures, even your house, from severe volatility that misses your stop? That is a fabulous question, and people talk about that all the time. They talk about in the futures markets, what if the market goes limit up and gaps through your stop, and next thing you know, you lose your house? Well, I'm not going to say that could never happen, because who knows? Anything can happen, but the chances of that happening are very, very slim. And nowadays, now that the futures markets trade basically 24 hours, it's actually pretty rare for you to see limit moves on consecutive days, because now that the trading times have been expanded, things are just a little more orderly. So I would be hard pressed to imagine a time where the market's going to go locked limit multiple days to a point where you're going to lose, all of your money or a lot of your money. That just doesn't normally happen anymore. But what I tend to tell people, I'm not a big fan of stop orders anyway. I think maybe using options as protection in some situations is a better idea. But that's I want to say that's maybe more folklore than anything. In my opinion, it's not any more risky than Forex. I mean, in both venues, you're trading leverage contracts. There's theoretically unlimited risk, but you manage your risks accordingly. I've been doing this for 8 years, and I can't think of one instance where somebody's stop was gapped through and things got really, really ugly. The only time actually, I take that back. There was one time. It was a silver collapse in 2000. I want to say 2004. People got slipped pretty horribly on their silver fills, but we're talking a couple thousand. I mean, it was painful, and I wanted to cry for them, but it wasn't. They weren't going to lose their house. And those types of things, I haven't seen anything like that happen in years and years and years. Again, because the markets are much more fluid in 24 hours. The name of my brokerage firm, our brokerage services, is DeCarly Trading. DeCarlyTrading.com. You can go there for educational information, and that's where our brokerage information is as well. In all honesty, someone's asking about actively managed currency ETFs. Are there some? I don't know of any. That doesn't mean that there aren't any, but from all of them that I'm aware of, it's kind of an index fund. They're either long or short, and they keep their ratios, and that's it. The margin requirements I don't have the current margin requirements for the E-micro futures contracts, but they range from about $200 to $400 on the E-micros, depending on if you're trading the euro or the Canadian or whichever contract. On the E-minis, which is half the size of the full size, most of them range between, I want to say, about $1,500 and maybe $2,000 for the mini. It might be a little less than that. I'm kind of trying to highball it. Okay. Somebody's asking if you can trade Forex futures. I'm assuming you're asking Forex and futures in the same trading platform, and that's absolutely possible. If you send me an email, I'll give you some information on that. It's dgarner@decarlytrading.com. Somebody's asking where the DE from DeCarly comes from. Well, that's a good question. There's basically two founders here at DeCarly, myself and Tracy DeCarlo, and her last name is DeCarlo, and my first name is Carly. So we basically just meshed our two names together, and that's what we ended up with. Are there any other questions?
All right. We want to thank Carly Garnier for accepting to join the session and answer to our questions. A very highly instructive session indeed. Also, our thanks to the great audience for participation. And for future sessions, we'll repeat the experience and keep introducing you with more interesting books. Stay tuned. Bye-bye, and have a pleasant and enjoyable week.